there's no question Jerome Powell needs to reconsider this 2% inflation target that he has because, in my opinion, he is very much losing this battle. And it's with a lot of areas that the Fed cannot control. Like the cost of insurance has gone up so much, the cost of oil and the cost to, escort it by Navy, fleet, as we're going 3,000 new nautical miles around Africa because we can't go through the normal channels because of new terrorist attacks, et cetera. So there's a lot of inflationary data coming right now. It leaves the Fed in a very, very, very difficult spot, but one that I think that we should ultimately talk about and have some conversations about because the consequences of having this so wrong could be devastating.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Got some big numbers out. PPI inflation is up 0.5%. Experts were surprised. I don't know who these experts are, David Stryzewski, but obviously it's nobody I know because all the experts I know were only surprised it wasn't higher. Maybe that's what the experts are really surprised about.
Yeah, it's always great to be with you, Kerry. When we talk about PPI, inflation in general, if people are not noticing right now that the season is changing and that a lot of this economic data that's coming out is beginning to deteriorate from this Goldilocks, everything's perfect, rosy, and we're going to have a soft landing scenario. So if we can't recognize the seasons change, I think that we probably need to examine our eyes. With the PPI numbers, that's otherwise said as the wholesale prices that producers or employers pay to create things. And so when we see inflation there, well, then we know that ultimately comes to the economy through CPI as well. And we'll get a new reading on that here tomorrow. A couple things to note, though, is that this is the third consecutive monthly read that is higher than the month prior to it. And why is that a really big deal? Well, because this talks about how sticky inflation ultimately is right now, and also gives us a forecast for where we're headed. I think it's a really big deal to note that if you actually, total up the last 3 months worth of inflation, that equals 1%. You times that by 4, that gives us a trajectory for 4% and this is PPI numbers here. The CPI numbers are between 4.4 and 4.5 based on how I calculated that. But that is a much higher inflationary environment than where we're set right now. So there's no question Jerome Powell needs to reconsider this 2% inflation target that he has because, in my opinion, he is very much losing this battle, and it's with a lot of areas that the Fed cannot control. Like the cost of insurance has gone up so much, the cost of oil and the cost to escort it by Navy. Fleet, as we're going 3,000 new nautical miles around Africa because we can't go through the normal channels because of new terrorist attacks, et cetera. So there's a lot of inflationary data coming right now, it leaves the Fed in a very, very, very difficult spot, but one that I think that we should ultimately talk about and have some conversations about because the consequences of having this so wrong could be devastating.
Hey, inflation is sticky, like when the mob gives somebody a pair of cement shoes, right?
Yeah, exactly.
It's not just sticky. Sticky's like flypaper. No, this is like monster glue on steroids here, this sticky.
Right. Well, and candidly, Kerry, over the last year, we actually look at inflation and CPI, PPI. We're not really seeing significant divergence in the numbers. CPI has been sitting in the 3s for over a year. It's not going down. It's been flatlined and just sort of leveled out here. By the way, as we look at oil prices right now and commodity prices, they've gone up significantly. And I believe that they will be, leading the rise in this inflationary environment, therefore making it more expensive to produce things. Another really, really big one that came out here just this last week is that both the ISM and the PMI indicators went negative. And what are those? They basically speak to the manufacturing and the servicing sector here in the United States. And when they go below 50, it's recessionary. And when either of them go below 50, we tend to have hiccups and challenges in the market. Today, both of them are negative. That's the second time that this has ever happened in the history. The two previous times were the .com and then 2008, great financial crisis. So if any of these two precursors are indicative of what the future might look like, or if they rhyme, if you will, then I think that we are headed for some major challenges here. And this is going to disrupt the thesis of so many today that have just bought long and they're all in. I mean, there's literally more bullish sentiment right now in the stock market than I guess going back to 2021 when everything was rallying to the top here and we hit all-time highs. So I think that when these two ideas of it's going to be really great and then holy smokes, it's actually not, catch up, I think that we could find ourselves in a real surprise moment here that could be devastating, especially if you're nearing or entering retirement like most of the families are that we work with.
Hey, so your feeling is the Fed's going to cut, but they're not going to cut until they absolutely 100% have to, right?
Absolutely right. So the Fed is at a very difficult spot here. And so I think that they're going to be forced to cut rates in order to avoid a banking crisis. And I say that in all humility because these are very serious matters that we're discussing here. But with inflation being too high for the Fed to cut rates, they're going to, have to remain higher for longer, just like they told us that they would, even though we were, pretty much guaranteed, according to statistics, that we were going to get cuts as of last July. So that didn't manifest. Anyway, we're in this higher for longer place right now. So I think that the Fed is stuck between preventing a banking crisis and preventing inflation from getting more out of control. Because if they drop rates right now, basically the top 20% of Americans, as far as financial goes, they've got money in the market. They're doing well, and they're going to, be off to the races. We'll see new all-time highs. That's very inflationary. 80% of the economy, though, in my opinion, is actually in a recession right now. And, I think that we probably need to even consider how are we defining recessions, because that would also ultimately determine how Fed policy and monetary policy, might be implemented in the economy. And I define it as, or I think it should be defined as, when the middle class is doing better or worse for 2 or 3 quarters at a time. We can see a trend in a positive or a negative direction and ultimately point back to the why behind it. Right now, the why is so many different things. It's actually difficult to even keep up on it. But getting back to that banking crisis right now, when we raise interest rates, the way that the Federal Reserve has done, this flips the entire credit cycle. This flips the entire market. The United States, all sectors, all families use credit to function in daily life. And so our banking industry is incredibly important. And what's taking place here is with higher interest rates. I'll just even point to the numbers that came out from Realtor.com, and that was in 2023, we had lower housing sales than the worst point in 2008. That's a staggering bit of information. Very few people are actually even sharing and talking about right now. But, the challenge is, when you go from a 3% mortgage environment to 7.52, I believe it is today, people have to come up with either 40% more money as income, or their purchasing power has been reduced by 40% plus in that example. And so the housing market is certainly, at least across the United States, in a very tenuous moment. We've obviously had a lot of big institutionals purchasing over the years, but I think that we're seeing this crisis begin right now in housing, and no one's going to be able to really get loans. These local regional banks are not going to be remetabolizing office space. And if you look at the office space numbers right now, it's a staggering number. Just to not name more facts here, but in April, 43% of small businesses in the United States were unable to pay their office lease. 43%.
Wow.
I can't even imagine that. Over 1,000 companies have announced that they are going to be shutting down locations this year. Over 1,000. Is that a really pro-growth economy, or is this a recessing economy? If we have eyes to see and ears to hear, we can recognize this is slowing down. It's slowing down dramatically. And I fear that it happens all at one time in this convergence, and we will not be prepared for it.
Hey, I just saw today, and this is in, I believe, Fort Worth, Texas, a high-rise 40-story building went for $12 a foot. Now,
Unbelievable.
Back in 1998, I think I was paying $10 a foot in New York City. So if I had just waited, I could have bought that place in Fort Worth.
Exactly. And so there's places in our economy that there's going to be deflation because of the interest rate challenges. So those prices have to come down because the sellers want to sell more than the buyers want to buy. They don't have a choice. And so they need something for it. And so there's always a market that's being made. And actually, if I could just parallel that idea to one of the concerns that I have today, and that is with the fact that we're printing $1 trillion every 100 days. And if we understand how supply and demand work, or inflation actually works, inflation is literally a phenomenon that's created by central banks as a result of their printing and basically giving us the tax of least resistance. So instead of raising our taxes, they print more money. Well, so someone's got to buy that. And so China used to be the biggest net buyer. They're a seller. Saudi Arabia used to be a net buyer. They're no longer doing that. In fact, they've just joined the BRICS nations as of January 1st. And so they're no longer excited about the U.S. dollar, and they're trading now outside of the U.S. dollar for oil and gas. If we look at all of these things kind of collectively coming together here, this is a very concerning time for us to be looking at the world and where we're headed. Because in the world of having to sell new treasuries, if we don't have new buyers, like as an example, Japan's no longer buying. Well, what happens to the price? If there's no buyer, the price will go higher, or the yield has to go higher in order for somebody to say, okay, it's worth it now. I'll fix some money. I'll put some money into there, and instead of being in the stock market and thinking that everything's going to be running. So I think that you'll see people flee back into treasuries right now, and it'll get bought for a little bit. But I think as we get closer to the end of the summer, September, fall, October, and we've got more expenses coming in, more printing going on, more deterioration in the numbers, that we could find ourselves in a moment where we have a very, very significant hiccup in the treasury market. And that's when you see real challenges because, we're going to spend over $1 trillion this year as a nation in treasury debt. The U.S. taxpayers on the hooks for that. The Fed, is going to keep these rates higher. In fact, they could go higher even yet if what I just shared plays true. So again, when there's more supply than there are buyers, the price has to go up. And that is a devastating idea for bondholders today, especially those that are nearing and entering retirement and don't have time to recover from these losses.
All right. Well, definitely interesting times ahead. So what are you supposed to do? Bitcoin, gold, silver, diamonds, bananas? What do you do?
I think everyone's kind of asking some questions right now, and that is, what is real money? I personally believe that real money is gold and silver. And it takes just more dollars to purchase real money, gold and silver, than it did just 6 months ago, about 20% more. So I think that gold has led to a new high, and I think that it will break 3,400 here, probably even within the next 30 days. And once that does, just watch, because silver is going to rally very hard. Mm-hmm. And through the end of the year, I believe that silver is going to outperform gold at least 2 to 1. I think that oil per barrel, you're looking at $100 a barrel by year end. Could be higher than that, if I can be honest, especially with new tensions in the Middle East. We're obviously seeing, other metals like copper and steel see, very, very significant upswings right now. And so, more of a commodities-based approach, I think, is going to be valuable. But let's just be clear about this as well. Running AI and everything associated with EVs, it's going to take a lot of electricity. So I think that there's some value in some utilities as well. And so I got, couple thoughts as it relates to that and how to play that. But metal miners will be good as well, given the fact that their PE ratios are lower. They've been undervalued basically for 2 decades. And I think that they're about to get repriced and really be seen for the value that they have. We'll see if the Biden administration lets them drill and figure some things out. But, until that occurs, we've got what we've got. And in the last part there is that, those oil producers, I don't think that they will cut their dividends. And so for those that are looking for income, the dividends from certain oil producers, I think they're going to be consistent. And they've got plenty of margin in there based on what the costs are to produce relative to what, we're paying at the pump here. And that's even if there's a slowdown. We're going to see any of those ideas, I believe, continue to grow and continue to take off. So, there's some thoughts. So,
all right. Well, hey, I'm a huge utility bull. I was a big bull before the AI thing hit. Now, because I'm figuring, hey, the EVs, man, that's inexorable trend. As more and more go, we're going to see demand increase. What's good about EVs is that most of them get charged at night, at least if you're in a home charger situation. Sure. So it's perfect for the utility companies. They don't really need to increase capacity to service this new fleet of cars. But AI is a whole nother story. I think the AI combined with the mega battery packs really going to be where it's at, where you can store up the electricity, get it at night. Beauty is the ability of those things is to buy energy at the lowest possible price. Like in Florida here, just for a home, 7 cents a kilowatt hour, regular tax, 13 cents a kilowatt hour. So you can stock up all that energy and then basically use it during the day when you need it. Actually, they use it 24/7. But my point is that's going to be invaluable. It's going to help pay for those things for sure.
Yeah.
All right, David, always great to have you on. Tell us, where do we find you on the web? How do we connect with you?
Yeah. So our website is myspg.com. I've also got a site out there offering some great information, and that is fedbubble.com, fedbubble.com.
Bubble.
And, you got to name the perpetrator who caused it to bubble to pop. And so that is the Federal Reserve. And I think that we should be critical of those who have the ability to affect our lives in such significant ways. So there's been big mistakes that have been made, and we have absolute bubbles that are amongst us right now. So, just hopeful that people can certainly survive in these financial times. And so appreciate your time here today and the opportunity to be on your show as this is a key time to be having the right answers and to be understanding what the future is going to be holding.
Couldn't agree with you more. Hey, David, always appreciate you coming on. Got a question for David or myself. The email address is kl@kerrylutz.com. You'll find a link to fedbubble.com in the show notes to this interview on financialsurvivalnetwork.com. We just ask, if you visit, please sign up for your free newsletter. David, always a pleasure. We'll talk to you again soon.
Appreciate you, Kerry. Thanks so much. Talk to you soon.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.